Let's bring on board then Mark Matthews, head of research Asia at Bank Julius Baer. He joins us on the chat right now to talk about his thoughts on global equities as well as India. Mark, hi, morning. What explains the weakness that we're seeing across U.S. equities as well as Asia this morning, firstly?
Well, markets don't go up in a straight line, so I don't think there's anything wrong particularly in the world. I guess if you wanted to pinpoint one thing, it's the fact that the extremists are taking back Mosul and Tikrit in Iraq. But apart from that, I can't think of any other reason why markets are down.
Mark, there seems to be an unusual calm in global markets in general. We've not seen a big or a large correction in any major market. Global volatility has plunged to a historic low. Everyone is convinced that tapering is history and ECB and BOJ will continue to print money. Never take markets for granted. Suddenly everyone is taking the global setup for granted.
Yes, I hear a lot of commentary to that effect, and as much as it's true the volatility is close to historic lows. I think the VIX is around just over 10. I think it's for a good reason. I think that in the U.S., all the data show the economy's recovering, and in fact will probably be more robust than we'd anticipated. As you correctly say, the ECB has started its LTRO, and it's got an implicit threat of quantitative easing if that doesn't help get inflation up. Japan, the data's been very good, and in China, I think the data has also become much more robust than anticipated. And then in India, you've got a new government, which is very pro-business. So I don't really see what there isn't to like in the world right now.
Mm-hmm. What's the view then on Mark when it comes to India? We've had a fair amount of, or rather I should say, consistent inflows coming into the country. Does it seem like that's going to be a steady phenomena and the noises that the government is making are all correct and right?
Well, I can't speak on behalf of the foreign investment community, but I think the key number is that Modi has 62% of parliament, and that means that he can get done what he wants to get done. And we've already seen since he took office lots of things. Cabinet ministers have to arrive at 9 a.m. sharp at their offices. They've got to clean up their desks. They've got to make PowerPoint presentations to the prime minister. He wants to know where projects are delayed and why they're delayed. I think it's all good, and his track record of implementation in Gujarat strongly suggests that he can replicate at least some of that nationwide, and therefore the economy should accelerate.
Mark, so let me be the devil's advocate. Markets always climb wall of worry and they always come down on ray of hope. Right now everyone is hopeful, confident and certain.
Well, not sure if that's true. I've seen plenty of markets fall when people are worried, and I've seen plenty of markets go up when people are enthusiastic. So I don't necessarily subscribe to that view. Look, if there's a good story, why stand in the face of it? And there's a good story in India.
Mark, the problem for Indian economy is unique. It's got a very strong local inflation, food inflation. The news from India is that this time monsoons will be delayed, monsoons will be subpar, which clearly will have an impact on food prices. If food prices go up, that will challenge the entire rate regime. Do you think in the short term the biggest challenge for Indian economy is still monitoring inflation?
I do think that it is, but I also think monsoons are not the culprit behind the doubling of food prices in India over the past decade. The culprit has been the very inefficient distribution of food and the fact that the Congress Party was subsidizing grain prices, which meant that farmers started growing grains and stopped growing vegetables, and that's when onions and tomatoes really started to skyrocket. So I think with improved distribution, hopefully a crackdown on corruption so that trucking unions and the like are not used by profiteers to hoard vegetables and play around with their prices. I actually do think the potential for much lower food inflation is entirely realistic under this new government.
So, Mark, let's talk about valuations. We've always seen that expectations and valuations, they never go hand in hand. For the moment, valuations have run up, expectations are high. Some would argue that valuations are looking slightly stretched. But do you think valuations will remain slightly stretched for Indian stocks because the India rhetoric has changed? We've seen a tectonic shift, more like a generational shift when it comes to the new government, new mandate.
Yeah, I mean, I'll just give you a slightly obscure example that pops into my mind as you ask me that question. It's the Philippines. I remember 10 years ago, maybe it was about 11 or 12 years ago, the Philippines was trading on about 25 times price to earnings ratio. So, of course, that was considered very stretched, very expensive. Well, I think the market's up at least twice, probably more like 3 times since then, because ultimately what moves share prices is cash flow. And what kicked in the Philippines over the past decade was strong cash flow. And reasons were quite different from India. I won't go into them, but I can see in India the prospect for much stronger cash flow from the corporate sector over the next 5 years than has been the case over the past 5 years. And in that case, valuations are not stretched at all.
Mark, what's the view on the recent economic data out of China, and what is it that you've made of the recovery or non-recovery that the equity would see from here?
Well, I think the key in China is that at the beginning of this year, everybody was expecting a raft of defaults to have occurred by now. And there were 2 defaults that occurred around, I guess, February. One was a solar panel company. The other was a property company that people thought were the beginning of a big wave. And it simply never happened. There hasn't been defaults in China. And I guess the reason for that is that although this government has not enacted a massive stimulus like their predecessors in 2009. They have enacted about 30 what we call mini stimuli, which are very targeted towards small and medium-sized enterprises, toward logistics, transportation, agriculture. And anyway, when you add all these up, it's starting to have an impact on growth in China. Growth is beating expectations, starting to beat expectations quite a lot, actually. And the other number I'll give you is that fiscal expenditure was up 25% in May, and nobody saw that one coming. It's also a combination of those 30 mini stimuli. So the data in China is actually very good.
Right. Mark, what could really pour cold water on the current setup? Will it be Fed? Will it be China? Or something really could backfire when it comes to Europe?
Well, just thinking back on 2013, I think it could be the Federal Reserve. And you may recall that it was in May of last year when Ben Bernanke said that he would start to taper the quantitative easing program. And then we went through the whole summer basically losing a lot of ground in markets around the world as people tried to understand the impact of that. And so too today, I think it's possible the Fed brings forward the time it decides to raise interest rates because of the improving economy. And the person who I'm thinking about actually is the Federal Reserve President of St. Louis, James Bullard. And the reason I'm thinking of him is he, back in February of 2013, was the first person to say that the Federal Reserve should scale back its quantitative easing program. So that was a good 2-3 months before Ben Bernanke said the same. Ben Bernanke said it in March of last year, not May, like I told you earlier. Anyway, last week, James Bullard gave an interview to the Wall Street Journal, and he said that because the economy is doing so well, they should actually start to look at raising interest rates in the fall of this year and not mid-2015, which is what the Fed has been broadcasting. So, if history's any precedent, Bullard told us in February of last year about tapering, and then Bernanke followed through in March. Could it be that 2 months from now, Yellen starts talking about interest rates going up in the second half of this year? If that's the case, then I think you definitely have a nasty correction in markets. But I don't know. I mean, he was a voting member last year, and he's not this year, Mr. Bullard. Who knows? But that would be my only concern, is that the Fed starts changing its targeting for raising interest rates.